You're watching the Daily Market Comment by Mario Sittikiriakos. I'm Christina Marujos, and thank you for joining us at XM.com. The imminent threat of higher taxes in America hasn't spooked financial markets so far, but the serenity will be tested today around 8 o'clock GMT when President Biden unveils the details of his ambitious infrastructure plan. The latest reports suggest the overall package will cost a little over $2 trillion, partially funded by raising taxes on businesses and investments. The striking part is how well markets have absorbed these leaks. This might reflect expectations that the final package will be watered down in Congress. Still, the actual details could be crucial. But even if the dollar and equities retreat as markets grapple with the threat of taxation, the overall trajectory for both seems positive in an environment where America out-vaccinates and out-recovers most nations. The grand theme setting the tempo in the FX scene is the spike in Treasury yields. This is translating into a stronger US dollar as the reserve currency regains its yield advantage, powered by expectations that the Fed will be among the first central banks to raise interest rates again. In contrast, the Japanese yen and the Swiss franc have been demolished by this rising yield environment as rate differentials widen against them. The euro is another popular funding currency that is likely to keep struggling. Europe has fallen way behind in the global immunization race. Several economies are still shut down, and government spending pales in comparison to America. It is difficult to imagine what can turn this narrative around. In equities, the S&P 500 retreated a touch but remains within breathing distance of its record highs. In this sense, the prospect of higher taxes doesn't seem fully priced in yet, so there might be a scope for a pullback. That said, any correction could be short-lived. In energy markets, there's an OPEC Plus meeting today. The cartel and its allies are unlikely to unwind their production cuts today as global demand is still far too fragile to absorb any meaningful increase in production. If the supply cuts are indeed extended, there might be a positive but minimal reaction in oil prices. Meanwhile, gold has been battered and bruised by the stronger dollar and rising treasury yields. A break below the 1,676 lows could be devastating. This was today's Daily Market Comment. Thank you for watching at XM.com.